Nvidia has undeniably benefited from the surge in AI. However, is this so-called AI bubble about to break, and what will that look like for Nvidia? Fasten your seatbelts, folks. This is going to be a good one. Nvidia has been around since 1993, and they were formed as a tech company with an overall goal to pay attention to where technology was moving and to thus become part of that vision. This led them into graphics process computing, as they had the foresight to see that graphics was going to be, well, beyond huge in the future. By 1999, they had developed their first graphical processing unit, or GPU, and this made them a significant entity in the gaming industry. Their chips excelled in processing a lot of data, and as such, they evolved beyond their original designs. With the rise of crypto, these chips became one of the more sought after for those crypto miners. Initially, the crypto miners were using the GPUs for their computations, which caused a shortage in, well, chips for everyone else. Nvidia released a specific chip for mining called a crypto mining processor, or a CMP, to help deal with the chip shortage. And this began a real push to take their product beyond graphics. This was going to be huge for them, as the development of a little thing called AI was about to create some very big opportunities. They played a massive role in AI development, primarily through their development and promotion of GPUs for AI and deep learning applications. Of course, they were about to once again take things beyond graphics. They came up with this little thing called CUDA, which is Compute Unified Device Architecture. So this CUDA technology was introduced in 2007, and it was a game changer, enabling researchers and developers to use Nvidia GPUs for general purpose processing. This would cause a significant acceleration of the computational capabilities required for AI algorithms and deep learning neural networks. As we moved into the AI surge, we have seen in the last year Nvidia's chips represent just over 70% of all chips being used by AI. They truly are the backbone of AI, and as AI has begun to transform our world, it has padded the portfolios of Nvidia's investors. However, some folks think that we are in an AI bubble and expect a lot of pain for Nvidia when that bubble breaks. Join today's conversation. Let me know in the comments if you think AI is in a bubble, or if you think it may be just, well, maybe something else. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. The question as to if we are in an AI bubble is quite debatable, and many experts in everything from finance and technology to, well, academia, they have their opinions. What we do know for sure is that a lot of AI companies do become highly inflated beyond their intrinsic value. This is due to exuberance in the market, speculation, and some overly optimistic expectations as to where AI is heading. Nvidia has become that one company that many see as the front leader in AI and in the so-called bubble. When Nvidia reports positive earnings, it almost seems like all of the AI companies tend to benefit to some degree or another. I think if we do see an AI bubble burst, Nvidia will feel some of it for sure. I don't think that is even an argument. The real question is, are we in an AI bubble? Between high valuations, tons of speculation, and the overall media hype, you certainly can argue that we may be in a bubble. However, there are good arguments that we are not in a bubble, such as the advancements in AI technology. Well, it's very real, as we have been seeing substantial advances in machine learning, natural language processing, and computer vision, among other areas. We have also seen a very broad industry adoption as more and more industries embrace chatbots and other AI applications. This does indicate that we have a high demand. In addition to that, there is so much long-term potential for AI. We are only scratching the surface of what AI can achieve thus far. The potential long-term impact on productivity, economic growth, and societal benefits could justify the current levels of investment and interest. Personally, I am leaning towards no bubble, which does not mean everything AI will succeed, but I think with how Nvidia is currently positioned, we do have some good potential there. Of course, we are here for their fundamentals, so we will definitely take a look at those numbers. And to do that, we once again need to call on our good old buddy, Mr. Math. As usual, we will begin with the surface data. At the time of recording, their current value comes in at $788.17. They did break that $800 mark last week, and I definitely expect them to probably break it again this week. Their market cap comes in at $1.97 trillion. We don't see that trillion that often, but it looks pretty good, and their market cap It broke 2 trillion last week as well. I do expect it to get back up to 2 trillion. They have a pretty volatile beta of 1.68. Their earnings per share come in at 11.90. And their price to earnings ratio, that comes in at 66.23. Amongst their peers, the average comes in at 30.4, so they're more than double that. Some of those other chip companies include Qualcomm with a PE of 22.0, Texas Instruments at 23, and Broadcom coming in at 43.1. Now, Nvidia's price to book ratio also pretty darn high, 45.10. The average amongst those same peers comes in at 11.1. Their return on equity, that comes in at 91.46%. Holy banana bread, that's a huge number. Normally, I only see numbers like that when we've got a crazy debt situation. So we'll find out later whether we do or not. The return on assets, another fantastic number, 35.55%. The surface data looks pretty darn good. There may be some arguments that they are, well, overvalued looking at a few of those ratios, but we already knew that going into this deep dive. Let's peel back another layer and get into their cash data. They have revenue of $60.92 billion, and their earnings came in at $29.76 billion. Those earnings are projected to grow by 22.2% per year. That is not too shabby. Now, this may be a statistic to file in your WOW folder, but their earnings in the last year grew by 578.6%. I'm beginning to see why some people feel like that's a bubble. The profit margin comes in at 48.8%. They had a free cash flow of $27.02 billion. Their operating cash flow came in at $28.09 billion. Let's take a look at their fair value. So their current value, $788.17. Using a discounted cash flow model, we do get a fair value of $524.98. So that does paint them as overvalued by 50.1%. So there it is, that big overvalued number that does scare off some investors as they worry about that bubble bursting. When we look at the 1-year target, analysts are actually predicting the price to go up to $873.33. That is an increase over the next year of 10.8%. That's not too shabby at all. Their cash is very nice, and I have no issues with this data. And despite the big overvalued number, I think this is a good cash situation. Okay, let's dive a little deeper and check out their returns. We already know these are going to be good. We'll start with their dividend as usual. They have a small, very small yield of 0.02%. It's a quarterly dividend paid out in the amount of 4 cents USD per share. Payout ratio, yeah, it's going to be small, 1.34%. As for dividend growth, there's been no dividend growth in the last 5 years, and that's fine because this is a company in the middle of massive growth. They're not really focused on those dividends. Let's look at that growth. Over the 3-year, their price went from $124.50 to $788.17. That's a return on investment of 533.07%. We factor in those dividends, we get a total return of 533.45%. That is phenomenal. If we look at that 1 year, on the 1 year, their price rose from $233.72 to $788.17. That is a return on investment of 237.23%. Add in the dividends, we get a total return of 237.30%. And so far this year in 2024, they're up 60.05%, so that's pretty darn good. For a company this big, these returns are almost off the chart. I have a hard time believing we will maintain the same pacing going forward, but there are some scenarios where I could be wrong on that point. Okay, it's time to take one more final dive deep down into that debt situation. So they have a total debt of $9.71 billion, and their total equity comes in at $42.98 billion. So that's a debt to equity ratio of 22.6%. Remember when I mentioned with the return on equity that it could have been inflated if we had crazy debt numbers? We don't have crazy debt numbers. That's a legitimate ROE. Just keep that in mind. Even though I do love this debt to equity ratio, I will point out it has increased from 5 years ago when it was coming in at 16.3%. Now, using debt to empower growth is normal, and I feel in this case it is perfectly justified. They are getting the results. When it comes to their cash and cash equivalents, Wow, they've got 25.98 billion. That's fantastic. Looking at their short term, their assets come in at 44.35 billion, and they've got short-term liabilities of 10.36 billion. That looks great. Long term, their assets come in at 21.38 billion, and their liabilities come in at 12.12 billion. Once again, that looks fantastic. Even our short-term assets are completely covering those long-term liabilities, so I love it. I love this. Overall, I love their debt situation. They do have the cash that they could easily clear up all of their debt if it was a priority, which it is not, as their growth has been taking center stage. We are not going to dig any deeper into their debt, as I do feel we are ready to ask that question. What is my final verdict? Nvidia looks great, and I do believe they have a lot of runway left. This is a company in the right place at the right time, and their share value will continue to reflect that. We may have a few corrections along the way that, in my opinion, are nothing more than good entry points if you are interested in this stock. I do expect to see those huge returns retreat a wee bit, but nonetheless, they may still be quite impressive this year. This is a stock that will benefit big time as AI continues to surge. So if you are following what AI does and what new technologies drop, you can get a better feel for what is going to happen with Nvidia. They are a very adaptable company, and this will bode well for them over the long term. Even if we do someday have an AI bubble burst, Nvidia will recover and still be a good choice over the long haul, just like Microsoft survived the dot-com burst. If you are interested in Nvidia, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on technology ETFs. Thank you for watching, and I will see you in the next video.